Have you received one of these letters? This is a letter sent by the Social Security Administration that mandates that this specific retired couple will owe an almost extra $6,000 in Medicare premiums moving into the following year. Ouch. Well, good news. In this video today, I'm going to show you how this couple may be able to get that penalty reversed and add, well, in their situation, $6,000 back into their pocket. Let's get into it. Now, there are two reasons that you may have a Medicare premium increase in retirement. The first is a late enrollment penalty. The second is an IRMAA penalty. Now, a late enrollment penalty is a topic we're not going to discuss too much in this video, but it's fairly straightforward to avoid. Simply make sure that you file on time for your Medicare enrollment period, and you will avoid this given penalty. Now, unfortunately, being subject to a late enrollment penalty is a permanent Medicare increase in most cases that will come back to bite you throughout your retirement. The premium increase that we are going to be focusing on in today's video is due to something called IRMAA, which stands for Income Related Monthly Adjustment Amount. Now, IRMAA is a fairly complex tax hurdle that we need to navigate. And IRMAA is essentially a mandate that if you show too much income, you will have an increased Part B as well as Part D premium. So how much exactly is too much income? On the screen, you can see the 2022 thresholds for IRMAA. And as you can see, as we add together Part B and Part D premiums, IRMAA can get quite expensive. Especially for a married couple. If both of you are on Medicare, you can basically multiply these IRMAA expenses by 2 because both of you will owe that extra Medicare premium increase. Now, IRMAA is somewhat complex for a couple different reasons. The first is it's based off something called modified adjusted gross income. This means that you take your AGI and you add in any tax-exempt interest. So you don't get to take the standard deduction. Again, it's based off your adjusted gross income, not your taxable income. It's also somewhat confusing because it's based on a 2-year look back. So when we look at the 2022 IRMAA tables, that's based on income that you would have showed in 2020. Your 2022 Medicare premiums are based on the income that you showed in 2020. And so it can be a little bit confusing because we're always looking back into the past at the income we previously made in order to determine our current Medicare premiums. Now, the good news is IRMAA is a one-time annual penalty. And so if you fall back below that threshold in the following year, you will only have that Part B and Part D increase for 1 year. Now, if you are subject to a Medicare premium increase, you will be sent this letter. This letter is called an initial determination letter and fully explains what IRMAA is and also shows you what your corresponding penalty will be for that given Medicare year. Now, as a retiree, if you're sent this letter, is there anything that you can do? Well, for some, the answer is yes. Some will qualify for being able to completely reverse this given penalty. For instance, a very common scenario that we often see is someone who is planning on retiring in their mid to late 60s. Now, let's say while they were working, they were earning enough that they were pushed above a given IRMAA threshold. Now, remember that IRMAA is a 2-year look back. So as it looks back at the income they were earning while they were working, they're likely going to be sent this initial determination letter and see a Medicare penalty because of it. And so often, soon-to-be retirees are hit with this given penalty. Well, the good news is they likely qualify to completely reverse this penalty. And they can do so by filing a Medicare appeal. Now, a Medicare appeal is essentially a reversal of this given penalty if you qualify for what's called a qualifying life-changing event. Now, there are a few different things that qualify as a life-changing event. Work reduction or work stopping is considered a qualifying event. So if you're someone who went from working to either dropping down to part-time work or retiring altogether, this is a qualifying event. You're basically telling the Social Security Administration, hey, I'm no longer working. That income that was pushing me above that previous IRMAA threshold is no longer part of my income, and so I want you to reverse this penalty. A relationship change is also considered a qualifying life-changing event. So if you were either just married, you were either just divorced, or you were either just widowed, that can also allow you to appeal based on what changed within your situation with that relationship change. The third category of life-changing events would be a loss of an income-producing asset or loss of pension income. So essentially, if you had income coming in that is no longer coming in, once again, that could be a qualifying event. The final category would be a settlement by your employer. So let's say that your employer went bankrupt and they paid out a large settlement to you for whatever given reason. Once again, this can be considered a qualifying life-changing event. Now, I'll talk through the process of filing an appeal here in just 1 second, but a common question that we receive is around large one-time taxable events. So let's say that we have a situation where somebody is downsizing their house and after selling their house, they have a large amount of capital gains that push them above a given IRMAA threshold. Or maybe somebody's performing a very large one-time Roth conversion that again pushes them above that IRMAA threshold. Is this something that qualifies as a life-changing event? Does this qualify for an appeal? Unfortunately, no. The Social Security Administration does not consider this a qualifying event. So this is very important as we think about planning out your situation, that large Roth conversions can push you up into IRMAA thresholds and subject you to a Medicare penalty increase. Now, I'll give you a quick Roth conversion tip towards the end of this video, but let me first explain how to file an appeal. Now, in order to file an IRMAA appeal, the first thing that you're going to want to do is download a form that's currently called SS-44. This form will do a great job walking you through the steps that you need to take. First, you're going to fill out the basic information that it asks for, and then you're going to scroll down to the qualifying events section. Now, you're going to have to choose why you believe you qualify, and then fill out the expected reduction in income due to this given event. So if you're qualifying based on work stoppage, you would fill out how much your income is going to drop in the following years based on that W-2 income no longer being part of your situation. So we're going to need to provide documentation that proves why we have this given qualifying event. So for work stoppage, that might be submitting a signed letter from your previous employer. For a relationship change, that might be something like submitting your marriage certificate. From here, you simply submit this to the Social Security Administration and wait for a response. Luckily, there is no cost to filing an appeal, so if you believe that you're right on the line and an appeal may be accepted, I would push you to file an appeal anyway. But let's talk about how you can use this appeal process to your advantage. Now, quick disclaimer here. This is not advice for your specific situation. This is for illustrative purposes. Make sure you're using experienced help with any retirement strategy that you implement. So first off, let's take somebody who is still working and they are earning enough that they pass a given IRMAA threshold. Well, they may have access to a loophole where they can perform a Roth conversion and add additional dollars and not be subject to any additional Medicare penalties. The reason being is because, yes, that Roth conversion will add additional dollars and potentially push them up into additional Medicare penalty zones, but remember, they're going to have a qualifying event because of work stoppage. Second, if you're single but are in a serious relationship, getting married may provide some IRMAA relief as well as some tax relief as well. The reason being is because a married filer has twice as much room in each IRMAA threshold than a single filer would have. And so you have additional income where you can fill up these given zones before seeing an additional Medicare penalty. Finally, if you have a large income producing asset like a large rental property, it may make sense to review all of the tax ramifications that you are subject to because of that large income producing asset. So this is both in the way of things like the Social Security tax torpedo, as well as things like IRMAA thresholds. If that income producing property is causing you into different penalty zones in retirement, it may make sense, specifically in this current real estate market, to analyze whether keeping that income producing property or taking the equity out of that property makes more sense. The point here is, as a retiree, you almost always have options and strategies that you can implement. But crucially, you have to be planning ahead of time. The more time that you have to plan, the more options that you have available to you. And speaking of planning, a retiree's most important decade is their 60s. This is a time period where a retiree can implement a lot of strategies in order to set themselves up for a better retirement in the following decades. We recently recorded a video talking through 8 things that you can do in your 60s to set the rest of your retirement up for success. We'll link to that video right here. From tax planning to Social Security to avoiding things like IRMAA, this video gives actionable advice that you can use in your situation. Again, click this video right here to learn more, and always remember that you don't need more money, you need a better plan. Thanks for watching, and we look forward to seeing you in the next video.